Welcome. It's the Southern Fried Finance Podcast, where your hosts, Vic and Mike, will cover a host of topics related to small business taxes. They'll also touch on an occasional baseball topic, some college football talk in season, and maybe some out. And obviously, we'll talk about the best fishing spots and our best barbecue joints we've found lately. But it's a tax issue, y'all. So sit back, grab something to drink, and get comfortable, and join us for the Southern Fried Finance Podcast. And here's your hosts, Vic and Mike.
Hey, everybody. I'm Mike Ferris. I got Vic Rouse here with me. We're on the third episode of the Southern Fried Finance Podcast. I hope you've been able to see the first couple of these. I'm Mike Ferris. I've got my firm here in Longmont, Colorado, working mostly with small business owners and entrepreneurs of various types. And a lot of these discussions are tailored to our client bases here. So, Vic, how you doing today?
Doing great. Thank you, Mike. I am a partner in Rouse, Rouse & Rouse, a CPA firm in Eden, North Carolina. My partner is my mom. So kind of unique situation. But anyway, this is our third of these podcasts. I have enjoyed doing them thoroughly. And this particular topic, I think we're going to enjoy, and hopefully it's helpful to you. We're going to talk about entity selection, which is an area that both of us do a large amount of consulting into, trying to help new business owners and some old business owners who are kind of restructuring their affairs.
Yeah, it is. It's a topic that comes up every week in the practice in some form or another, whether it's a client just asking the question or it's, one of us being proactive and talking about, oh, you're doing this. Let's talk about how we structure it. So choice of entity, early in our career, it was very different than it is now, mainly because we've got these LLCs in the mix. And the difference between the state law treatment for an LLC and the federal tax treatment for an LLC creates a lot of confusion. And then, we need to at least touch on trusts a little bit too, because that comes up in the discussions, especially with the wealth of advice that's available in various places that may or may not be all that accurate. Trusts are a common topic there. And you had some good comments on those a minute ago. What were you saying?
Well, I was doom scrolling on the internet like it's so easy for us to get sucked into. And there was a former NBA player who went to the university that we don't mention in my household, but he was talking about the use of trusts and his organizational structure. And I think it's important to understand there's a place for trusts, but trusts are an asset protection vehicle. Sometimes we do use those in an estate tax planning situation, perhaps, but it's an asset protection planning vehicle. It is not designed to be used for income tax purposes. In fact, trusts are very income tax inefficient. The next client that walks into my office that I advise to use a trust for income tax purposes will be the first one.
That's a great point. Trusts are common. We see them all the time. They have a very important place in the world, but they're not necessarily a tool that we're going to reach into and tap on for income tax planning purposes. But they've got income tax consequences for sure. And a lot of times they're not that favorable for the beneficiaries that are involved. So anyway, I don't want to get too hung up on that, but LLCs, everybody is using LLCs. They are the entity of choice in today's world, especially for small business owners. And the interesting thing is, from a federal tax perspective, LLCs don't exist. There is no definition of limited liability company in the federal tax law, and there are 50 definitions of LLCs under the various state laws. And so how does that come into play, and how does federal tax handle it? And we end up with some default treatment based on who owns the LLC, and most commonly, an individual creates an LLC to operate their business, and they are the only owner. And under magic, the LLC is just ignored for federal tax purposes. It's a disregarded entity. We treat it like it's a sole proprietorship, and all those sole proprietorship rules will apply. If there's another owner, then it might be a partnership. Most likely it would be, and then and then this thing about S corps comes up. So it can create a lot of confusion, right?
Well, it can, and LLCs, we like using LLCs because of their flexibility. So I can have an LLC, I can have an LLC that's taxed as a C corporation. I can have an LLC that's taxed as an S corporation. I can have an
Hmm.
LLC that's taxed as a partnership, or I can have an LLC that's disregarded for income
Yeah.
tax purposes. And that doesn't mean it's disregarded for state law purposes. Hopefully, we have maintained the LLC properly under the guidance of our attorneys or whoever is guiding us there. But the entity itself still very valid under state law. But for federal income tax purposes, if we only have one owner and we don't make a
It's
special election, it doesn't exist for federal tax purposes.
which is fascinating. I call it the two-headed monster phenomenon. You've got one set of rules for state law, and it's got its own set of results and opportunities and traps. And then you've got another set of rules for federal tax purposes that has its own set of opportunities, traps, and pitfalls. And the two have nothing to do with each other. And if you
True.
can kind of think about it that way, they're Venn diagrams with no overlap. You know, so
Yeah.
you end up with a S corp or a disregarded entity or a partnership over here, but for North Carolina or Colorado purposes, it's just an LLC. And state law liability laws apply and everything else that goes with it. So creates some interesting result, but it gives us an ability to manage liability protection for state law purposes and get the federal tax results and in most cases the state tax results that follow that we wanted out of whatever business structure we're trying to put in place. So most common question I get, and I bet you do too, is, hey, I think I should be an S corp. Should I make an S corp election? Should we be an S corp for this thing? So how many times a week do you get asked that?
Well, I think so. We're talking about this for tax purposes, right? We're tax focused. We're talking about this for tax purposes. So we've thrown out the trust thing. We're not talking about
Yeah.
that. We're going to operate this business as either a partnership, as a C corporation, as an S corporation, or we're not going to make any special election. We got one owner. We're going to be disregarded. It will be
Yeah.
a sole proprietor. And the truth is like I advise my clients sometimes to use all of these, maybe the
Well,
same taxpayer, but each of these has a place. Each of these has a place.
yeah.
And so I think there's a lot of internet guidance or
TikTok tax advice.
the TikTok tax advice, barbershop, doctor's office,
Backyard, over the fence. Yeah. Yeah.
airport lobby type of
Yeah.
advice out there. And so a lot of people say, hey, you need to be operating as an S corporation because you're going to save taxes. So let's say, Mike. So if I come into your office and I've got a small business and I say, Mike, um, my buddy told me that I needed to be an S corporation. Is that what we need to do with my LLC? And what is typically the advice, or what are you looking at to decide whether I should
Yeah.
be an S corporation or not?
A couple of low hanging items that we look at right out of the gate is, well, what kind of business are you in? Are you in a field that qualified as a specified trade or services business? And if that, if you're in healthcare, if you're in legal, accounting, architecture, some of these businesses, there's some other factors from other aspects of the law that come into play that may or may not indicate an S corp is more or less favorable, and that depends on the type of business, how much taxable income is going to be in your personal tax return, and that includes other businesses you're in, other jobs you might have, spousal income comes into play, and if that income's over certain thresholds, well then an S corp might be preferred or necessary even to obtain other tax benefits and make sure we're maximizing the entire internal revenue code for you. But honestly, for a lot of small taxpayers, an S corp is an extra layer of complexity that's really not applicable until the business develops and grows. Oh, another factor is how much debt is involved. Are you personally financing this with your money, or are you borrowing money from third parties that maybe you don't have to guarantee? Or if you do have to guarantee, how does all that look? And this all gets into, are we going to have losses? Are we going to be profitable out of the gate? All these factors come into play. So that ought to be kind of clear to anybody hearing this, that your fact pattern is very different probably than anybody else's. And so we might get very different results for people that look like they're doing the same thing sometimes.
Yeah, I think one of this thing, the one thing that you said there that I think is very important is that you said sometimes we're not making money early.
Right.
So one of the problems with the S corporation is if it's a loser. So, some businesses are not profitable right out of the gate. A lot of businesses are not profitable right out of the
For
gate.
a variety of reasons. Maybe that's
For-
on purpose because of depreciation deductions that we elected to make. There's all kinds of factors, but
but I think understanding whether we're going to make money or not, whether we plan to make money or not, and planning for maybe it doesn't go as well as we think it might. I think that's part of it too, which is the
yeah,
flexibility of using an LLC in your choice of entity kind of gives you the opportunity to maybe to have an entity that's not an S corporation, but then we have the opportunity to maybe turn it into one
flip it.
down the road. But
Yes.
the problem sometimes that we run into is we have an entity, it is an S corporation, and it has losses early. And and this goes to the debt question is sometimes we can't get
Yeah.
those losses out. We can't
Yeah.
get them out because of a basis problem
Yeah. We can't
with
get the benefit in the 1040 that we want to get from the losses because of how it's structured. So
right.
understanding that on the front end, and what is your first 3 years going to look like? And maybe for a lot of clients, it's not beneficial to be an S corp at the beginning because of losses and the way basis works. But we get hung up on that sometimes because we're
Yeah.
thinking a little myopically. So it's important to just pause and kind of plot out how things are going to look, at least how you think they're going to look. None of us have all that good a crystal ball, but
Yeah, I think the other thing I would like to point out on an S corporation that's a startup is even if we are profitable, which great, we are profitable. Are we going to be taking money out of that company? Do you need the money from the S corporation? Are you working in the S corporation? So you have this question that's often litigated or examined, or it has been in the past, maybe not so much recently because maybe the IRS enforcement actions have slowed. But with are you paying reasonable salaries to your S corporation shareholders? So if you've got an S corporation shareholder
yeah.
and they're working in the business and they're taking money out of that business, then they're supposed to be paying themselves salary. And that salary is supposed to be reasonable in light of what was the fair value for their
All the
services,
factors.
all the
and
factors.
and that's where so many practitioners get real short-sighted and a little bit aggressive. And maybe they don't necessarily even mean to. They're just focused on how much tax can I save, and I'm going to pay this person a paltry salary, and we're going to let all the income flow through as S corp income. They can distribute it all, and everybody's happy. We just didn't pay much tax, and I see that profile develop, and you've got to stop and try to coach people to understand your compensation needs to pay you for the work that you did, and
Yeah,
and that may not be the same as you would make if you worked in some other firm for somebody else, but your job would also be different, and the
right.
demands would be different. So it's all very unique and very facts and circumstances driven. But if you just focus on, I'm just going to pay a minimal salary and take all the money out as distributions, you're setting up a problem that might be hard to defend.
Well, the other thing that I think is well, there's a couple of reasons that sort of, I mean, bottom line, a lot of people are advised to be an S corporation because they're going to save FICA taxes.
That's Yep, and that's
I mean,
all they look at.
that's what
A-
they hear is
And
we're
they're
going to save
ignoring the part about retirement contributions. They're
exactly.
ignoring the part about qualified business income deduct. There's a lot of things that get overlooked in that myopic
The,
view. So
that's right. And where Mike is going with that is your retirement plan computation, what you can put into that retirement plan, your solo 401k or safe harbor 401k, or your retirement plan compensation is based on your W-2 income.
Right.
So if we're trying to put more into the retirement plan, and Mike and I, we talk about this all the time. I mean, the goal here is not just to pay the lowest amount of tax this year, but the
Right.
goal is to try to improve the financial health of our client over a long
Over
period of
a
time,
lifetime. Yeah.
a lifetime here. And retirement plan contributions are an important component of that. Um, the other side is the tax benefit that the startup S corporation that's not that profitable anymore. Well, the qualified business income deduction, the pass-through business income deduction that came in the Tax Cut and Jobs Act is based on the net income after we've paid the salary. Sometimes for some taxpayers, they're going to get maybe a much larger qualified business income deduction if they didn't have any sort of S corporation at all.
Being a partnership. Right. And if you compare the results of the SE tax and the QBID deduction net, it starts kind of taking care of itself. So
Yeah,
in a partnership too, I can allocate income just about any way I want to based on how the partners work together. Maybe one of them's in the business every day. Maybe the other one put up all the money. Maybe one of them's semi-retired now. But if they're equal shareholders, income has to allocate equally in an S corp. If we're partners, I can push it around based on how we want it to behave. Now, we got to do it right, and it's got to be in the agreement, and we book the capital accounts and all that good stuff. But we can give the money to the people that did the work.
Partnerships allow much more flexibility. And with a lot of my clients, I think that becomes very important, especially where we are maybe buying out a selling shareholder or a selling owner. If I'm in a partnership, bailing out a partner in a partnership, there are some tax advantages there that if we were simply buying like S corporation stock, that we would not be able to get. The complexity of that is beyond the scope of a podcast. But I think in terms of thinking about, sometimes S corporation is the right answer. Sometimes it is,
for sure.
but it's not the right answer all the time.
It's not the default that the marketplace wants to make it. Yeah.
I think in a partnership, or if you just sole proprietorship, it's easier to get assets in and out of the entity.
Yes.
Whereas in a corporation, I mean, we kind of understand in a corporation, if I put property into the corporation and you and I are shareholders in the S Corp, and then we decide we want to go our separate ways, we want to get all the property out, that property's got to come out at fair value. So sometimes we're going to have potentially an unfavorable tax result on dissolution
on just
in an S
winding it
corporation.
down. Once you make the S election, you've elected all the corporate rules, not just the pass-through stuff. So
Yeah,
it can be a trap for the unwary. And a big factor in that is once you make an S election, you give up forever being able to take advantage of Section 1202.
Oh, that's a great segue.
And it doesn't come up very often, but when it does, boy howdy, it's a big advantage. I did some planning this just summer with some folks that took advantage of 1202, and it just really opens your eyes to, it's worth considering before you make that S election. What is the possible exit strategy of this business? If it's a consulting deal that's very unique to just you, maybe it doesn't matter. If it's an operating business with some legs under it that's potentially saleable, you really ought to think about what might happen on down the road, and maybe being a C Corp or sole proprietor for a little while is perfectly fine.
Yeah, so where Mike is going here with Section 1202, we get so excited about it, we can't hardly wipe the grin off our face. So Section 1202 applies if you're a C corporation, okay? And if you're small enough, and on the exit, there is a potential on a stock sale exit. There's the potential
hard to do, but
to have tax-free capital gain on the back end. And we've seen it a couple of times with some clients that it fit the right fact pattern. Most of the time, businesses don't sell in a stock sale. Most of the time, they don't, but sometimes they do.
Every
And
now
if
and then it
you
works.
have, the sort of tech startup or something in that area where there's some intellectual property, perhaps, um, maybe there's a potential to exit in a stock sale and get a tax-free gain on exit. That could be a major benefit for the right taxpayer, but it doesn't happen. It doesn't happen for everybody,
It's
and
a
it's
narrow
not
set of
some.
circumstances to line up,
Yeah,
but if you
it,
can put it in place and give yourself a chance, in
well,
today's world, being a C Corp means you're paying tax at 21% at the corporate level. And on the exit, it's going to be a long-term capital gain. So that's something 20% or lower today. Your dividends would be qualified dividends during the lifetime of the business, assuming it's a U.S. business. So, being a C Corp's more favorable than it was early in our careers.
certainly at a 21% rate, that makes a big difference when we're profitable. I think to me, what does the small business startup lose by being a C Corp and trying to play for 1202? Well, a lot of these things, they lose money early. We have these losses that may just be pinned in the C corporation. We
Yeah.
can't reduce the owner, and maybe the owner is
Yeah.
a high income person that would like to take those losses, and maybe they're having to fund those losses and with their own money, and they would like to be able to deduct them on their own tax return. If we're in a C corp, we don't
Yeah.
get that. So there's a trade-off here
There is.
about,
There's
okay, how
trade-offs. And
important is it to get those tax losses out? If that's what we're going to
what
have.
what are the
Um,
goals, right? That's like
right.
any client
Yeah.
arrangement. What are the goals we're trying to achieve? Which of these entity choices best suits our goals and our purposes and our fact patterns? I mean, the facts dictate the answers in these things, that we don't make them up based on what we want to do from tax world perspective. So
But I think one point is, we've got a lot of choices. We've got some different directions to go when we're talking about entity selection. Um, it's it's hard to do very much with it after we've already put something in place and it wasn't the right thing. So getting some good advice from your
it's
accountant and from
important.
your attorney, to make sure that we're set up in a way that's appropriate for the type of business we have, what kind of assets we're going to own, how we're going to capitalize that business, and whether we're going to make money or not. And eventually, I know everybody wants to make money. We hope to make money. That is part of the goal here.
That's why we're
But
starting. But
yeah,
what are we going
but
to do these first 3 years?
yeah,
How's that
yeah,
going to look? And
right.
maybe and then we change it as the situation evolves and develops. And so, and I guess the takeaway here is that no situation is the same as the last one. Whatever your neighbor told you he was doing is probably great for him. It might be appropriate for you. It might not. Let's
Yeah.
talk about it.
Yeah, I
Let's
think
figure it
that's I
out.
think
Yeah.
that's I think that's excellent advice, and it is one of my favorite things to do. I mean, it's always exciting when somebody's talking about a startup or trying to do some restructuring, and a lot of times we
Yeah.
can help them, which is kind of what we're trying to do. That is the kind of gratifying part of our profession, but I think getting good advice on the front end is helpful, and potentially, to create some long-term benefit, not just 1 year benefit, but creating
Yeah,
long-term
not
benefit.
1 year, long term, and that's the goal. Is it's not just this year we're looking at the whole picture. So it's but it's hard. It's like anything else. We do the best we can with what we see in front of us, and then try to be adaptive and flexible as everything changes around us,
That's right.
because everything changes around us.
Awfully quickly, awfully quickly.
Cool.
Well, Mike, I am going to tell you that I am off this week. I am planning to go fishing here in a couple of days, and so probably a couple of days before we can get one of these put together again. But I do have to
Well,
make one special mention. My son's Lynchburg Hornets soccer team has advanced to the Sweet 16 of the Division III soccer playoffs. So
that is one
excited.
of the coolest things ever. I love it.
Yeah, and I'm so excited. It's a great group. It's fun watching them play. We just hope we can keep playing a little bit
Keep it
longer.
up. Hope they keep it up. Well, send me some pictures of some big speckled trouts, man.
I'm gonna do my best. I promise.
I'll be looking forward to it. Well, have a good time. See you later. We'll do
All
this
right.
again probably next week.
Thanks, Mike.
Thanks.
Well, thanks for joining us, everybody. This has been an episode of Southern Fried Finance, produced by Michael F. Ferris, CPA, LLC. Vic and Mike really thank you for being here and hope you can join us again next time.